My portfolio is currently yielding more than 11%. There are 37 stocks and funds, but most of them are tied to three themes that define my income strategy for 2025. Today, we'll dive into those three themes, using plenty of examples. The first theme is deregulation. Business development companies, or BDCs, pay an average yield of 11.2%, and that's not including the supplemental distributions that many of them issue. Include those, and the average yield moves up to 12%. BDCs are likely to benefit from the new administration's approach to deregulation. Nobody knows which policies will actually come to pass, but there are some likely outcomes. One example is an increase in the volume of mergers and acquisitions, or M&A activity. Unlike banks, BDCs can take an ownership interest in the companies they lend to. For example, they could structure a business loan to be repaid in interest payments, plus a 1% ownership in the company. The challenge is turning that 1% ownership into cash. BDCs lend to private companies, so they can't just sell their shares on the New York Stock Exchange. The two key ways to monetize those equity positions are number one, mergers and acquisitions, and number two, IPOs. In the case of mergers and acquisitions, if the borrower is acquired by another company for cash, all stockholders, including potentially the BDC, get paid. If there's an IPO, the cash comes from selling newly issued shares on the stock market. Most BDC income comes from interest payments, much like a bank, but the equity positions are potentially a lot more profitable, and those profits rely on the flow of M&A transactions and IPOs. In recent years, the volume of IPOs and M&A deals has fallen below their all-time high, although IPOs are starting to trend up again. To a large extent, that's driven by interest rates, but the level of regulation is also a factor. There are plenty of BDCs to choose from, but they're not all great investments. Some offer a high yield because, well, they're just excessively risky. Rather than trying to choose, you can get exposure to BDCs with a fund that specializes in them. The largest BDC fund is BIZD, B-I-Z-D, which is based on a BDC index and currently yields 11%. I prefer PBDC, which is actively managed and yields about 9.5%. Since its inception in 2022, PBDC has nudged ahead of BIZD in total return. This total return chart came from Seeking Alpha. It's also my primary source for all things income investing related. If you'd like to learn how I use total return charts, distribution charts, and other tools, check out this video. Link in the description for the video, and there's a link for a discount on Seeking Alpha membership. I use the premium level. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's called Armchair Insider. Link in the description, it's free. One last point about deregulation. It will also affect digital assets, the most obvious one being Bitcoin. And as I explained in a recent video, Bitcoin income funds have been paying out the biggest yields in excess of 20%. BITO is the largest player in the space with $2.7 billion under management. In the past year, the yield has ranged from 11% all the way up to 67%, as shown on this yield history chart from Snowball. I prefer more consistency than that, but even a low of 11% is pretty good. That one's obviously fairly risky, so I keep the allocation small. One thing I've learned over the past couple of years is that just when I think I know what's going to happen to interest rates, something changes and I realize I don't know what's going to happen to interest rates. Nobody does. Generally, lower interest rates are better for stocks, but I want to be more diversified than just stocks. There are plenty of excellent opportunities in the credit sector, and some of these do better with rising rates, while others do better with falling rates. Let's start with the falling rates. This is the current market sentiment, and it favors fixed rate investments and investments that require leverage. An example of fixed-rate investments would be PDI. It's yielding over 14% and has a long history of paying consistent distributions going all the way back to 2012, not to mention a handful of supplemental distributions. This distribution chart came from Snowball, but I mostly use Snowball to keep track of my income. I can rank my portfolio by current yield to see if there's something I want to sell, but most importantly, I can see a calendar that tells me how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. PDI isn't a pure fixed income fund, but its portfolio is weighted mostly in that direction. For example, corporate bonds and mortgage-backed securities. Changes in interest rates don't affect the income from fixed rate investments. If the interest rate for a bond is set at, say, 7%, then it stays at 7%, regardless of what the Fed does. But if the Fed cuts rates, then that 7% fixed becomes a little bit more attractive compared to short-term treasuries, which would now pay less. The result is that the value of the 7% fixed bond goes up. I mentioned leverage a minute ago. PDI is also an example of how falling rates help leveraged funds. PDI is just over 35% leveraged, which is at the upper end of the scale for a closed-end fund. Their interest expense is fairly high, and lower interest rates would move some of that expense over to shareholder distributions, which would be good. What if the Fed reverses course and rates start to rise again? Well, then floating rate funds will start paying higher distributions. EIC is paying a yield of just over 15%. It's a collateralized loan obligation fund at the higher end of the risk spectrum. But you can also buy a low-risk CLO like JAAA that yields just under 6%. And there are several options in between those two extremes. Higher interest rates weren't a consideration 6 months ago, but the unknowns around proposed tariffs mean that inflation is a possibility once again. If inflation returns, then so will higher interest rates. CLOs contain floating rate loans that move up and down with interest rates. Higher rates mean higher income, as you can see from this distribution history chart. So to summarize, fixed rate funds are more attractive if rates continue to fall, and floating rate investments are more attractive if rates go up again. I'll close out this section with some examples of funds that straddle the fence. In other words, neutral. I've already mentioned BDC funds today, and I've covered the relationship between BDCs and interest rates in a previous video. But in short, well-managed BDCs can do well whether rates are going up or down. Another example is a preferred share fund like PFFA. It's currently yielding 9%. I say straddle the fence because preferred shares typically start out as fixed income investments. Then, at a specified date, they switch to floating rate. A fund like PFFA can hold both fixed and floating, and they can make adjustments from one to the other based on their outlook for interest rates. Post-pandemic, PFFA has been gradually increasing its distributions. It's one of my top 10 holdings as I record this. The third and final theme we'll cover today is the use of covered call index funds. Examples include funds based on broad indexes like SPYI and GPIX for the S&P 500, and JEPQ and QQQI for the NASDAQ 100. Even though the S&P 500 and the NASDAQ 100 are arguably expensive at the moment and prone to volatility, I still like them for income generation. The good news is that covered call funds generate more income when volatility is high. The income comes from selling some of the upside of the index using call options, and if you're not familiar with that strategy, it's explained in this video. Beyond the broad index covered call funds, there are also ETFs that lean harder into tech, like FEPI, which is currently yielding a crazy 26%, or the more conservative BST, which has a much longer track record and yields a respectable 8%. These covered call funds do best in flat or mildly bullish markets, and they do okay during strong bull markets. Their downside is that following a prolonged correction, they take longer to recover than their indexes do. I want to quickly mention one fund in my top 10 holdings that doesn't really fit into any category, and that's SVOL, SVOL. It generates a yield of about 16% by shorting the VIX. It does well under normal market conditions, but if the VIX spikes, which is generally a sign of fear, the value drops. If the new administration introduces policies that cause the VIX to spike, I'll reconsider holding this fund. I've mentioned a lot of funds today, and each has their own risks, so I use diversification to reduce risk, capping the largest exposure at approximately 5%. The weightings are listed in the Armchair Insider portfolio. Now, I'm an investor, not a trader, and I'm not suggesting to buy into these sectors because their values are about to pop. I'm just saying that these are the areas I've been focusing on for the past few years and the reasons why I continue to focus on them, despite a change in Washington. Deregulation will be a tailwind for BDCs and crypto. Interest rates look like they're headed down, but I don't want to rely on that happening, so a mix of fixed and floating rate credit funds. And last of all, the covered call index funds turn market volatility into income. No doubt there will be a few tweaks going forward, but I'm not planning any radical moves, like taking a large cash position or exiting a sector completely. Before I go, I mostly make videos about investments I like, but I do like some more than others. If you want a recent overview of my top 10 holdings, then click over here. That wraps it up for this look at my approach to income investing for 2025. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.